Hello and welcome to March 22nd. Alpha's ITB at 35%. It's a bit of a dip. It was 36 on Friday, it's 35 today, so at least it's holding steady. The account is running approximately $100 behind its year to date. And we are looking here at our ITB, and we closed the first ratio and are now plateauing in this zone, waiting to reach that third ROI. Okay, that takes us now to KR. Here at KR. At KR, we are looking at, we did cross, we go almost, oh, look at this. We're just shy of a couple of pennies of the second ratio. And then after that, just another $1.50 to get to get to that 37.70. And we're about 90, we are 93 cents on ATR. So that's still 2 days away on getting to that target. Walgreen, here at Walgreen, we are running here at Walgreen, and Walgreen is closed above the first ratio, and then did a little bit of a pullback right in there, a little bit of a pullback. So there isn't much going on. We're still looking on a 3-to-1 ratio. Remember, the 3-to-1 ratio is we're risking 1 unit to make 3, and we'll be sticking with that until the next Elvis Shift, which is coming up on April 1st, and we haven't decided if we're going to do an Elvis Shift for April 1st at this time. Some notions were brought up in the table. Says to use the closed ratio exit rule, which would have worked in this kind of environment where stocks are kind of flatlining. So it gets up to a point and it closes and then starts falling back. Well, the first explaining what the closed ratio rule. Closed ratio rule is when you have a close above the ratio, then you move your stop to the ratio right there. And then technically we would have been stopped out here back on Wednesday the 17th. We've been stopped out here with a 1-to-1 win, whatever that 1-to-1 win produces. The philosophy behind it is to have compound wins. If you compound one win on top of one win on top of one win, then you double your money. And with the rules probability, it would be doubled in approximately about 4 trades. Okay, so that's the idea. We're going to see if we're going to go into that. We have one more to make a decision before we get to April 1st for an Elvis Shift, if we wish so. Also, note the Elvis Shifts are done on the first of the month. And I believe the first is Wednesday or Thursday going into the new month. Okay, coming on down now. That was the lesson for today. Was the 3-to-1 ratio and also what a close ratio exit is. Okay, that takes us now down to T for AT&T. In the media world, AT&T owns Warner Brothers. Warner Brothers owns HBO, and HBO is doing some big push into the media content world now that things in the economy are opening up. So we'll see how that's going to happen. Hey, they also had a first close ratio, and if we had done a close ratio loss stop, we would have been stopped out here, right there on that first ratio. So that's an example of what could have been, which we would end up compiling a bunch of winners on that first ratio. But what you give up, let's find out what is the counterpoint. If you take profit on the first ratio, then you do not, or you are not waiting for the third ratio, which could be more lucrative in the long run. But at the same time, winning one-on-one along the route can be also be. So it's an unknown territory, and that would be something to be considered for a possible Elvis Shift. Then going on to RT, no, that's it. Oh, no, CVS. CVS is at 1%, and that is our last of the positive territories in the options. Let's go on to our one positive territory, REI. Now, remember, REI, I mentioned last week, if we had done a portfolio manager's exit, we would have been out of this trade. Let me zoom in a little closer. We would have been out of this trade. No, that's RCL. Oh, RCL is interesting. It's flatlining, and we are in a put. So it's a flat lining put, RCL. It's running at minus 43%. I meant to get REI. REI is an equity, and that is our penny stock trade. And our penny stock trade is to see about how does the stochastics theory hold up in finding penny stocks. And just to review that last week, we hit 22% right here on this candle. And we would have then gone and taken profit on the next day opening, and we would have got out with profit up here of over 22%. That is known as your portfolio exit rule. So we have to review two additional rules of exits. And these rules are your discretion of which one you're going to use, but you got to be consistent in using them. That's why I do not shift to a new exit in the middle of the month. I wait for the month to conclude and then go on to the next month if I wish to move on to a new exit, a new Elvis Shift. And the purpose is to be able that when I go to Thinkorswim and I go to the accounting department of wins and losses, then I'm able to type in the whole month and say, how did it do for the month? And how did they compare to the previous month? So that's why I do also shift on the first of the month. All right, so we have REI, and it's back at 6% here, and it's dojied right there at 6% right at this point. And now we're going to see what's going to be happening in the upcoming future with that. That is really does a conclusion of that of today's report for Losers Become Winners. Reviewing the lessons on number 1 was your 3-to-1 exit rule. Another rule, alternative rule, is close exit on close above the ratio exit, and then the take profit portfolio manager's profit of taking profit at 20% as a target trade. And with that, I thank you very much for stopping by and checking it out. Bye bye.